This video presents a direct informational narration of the source document. All right, let's get right into the market and equities commentary for Thursday, April 23rd, 2026.
So here's what we're going to cover today. We'll kick things off with the market pulse, then get into a pretty wild story. We're calling it a cockroach sighting. After that, we'll look at some key economic signals, do a stock deep dive on some big names, and wrap up with the capital flow headwinds that could really impact trading next week.
First up, let's check the market's pulse. Today was one of those days where geopolitics just completely rattled the market, and it caused some pretty fascinating sector rotations under the surface.
Man, the market really took us for a ride today, didn't it? The morning started out pretty calm, but then bam, right around midday, we got this sudden sharp drop. It was all sparked by some unconfirmed rumors coming out of the Middle East. Then, almost as fast as it dropped, the market bounced back after those reports were denied. But, despite that comeback, the early damage stuck, and all four major indices still ended the day in the red.
But this is where it gets really interesting when you look under the hood. It was basically a tale of two markets. You had technology and consumer discretionary getting hit pretty hard, mostly dragged down by software stocks and big players like Microsoft and Tesla. At the same time, you saw money just pouring into semiconductors, which have been on a tear, and also into industrials, real estate, and utilities.
Okay, next up is a story that honestly sounds like it's straight out of a movie. It's about this cockroach sighting, as they call it, in the wild world of prediction markets, and it's all about alleged insider trading. So get this, the FBI actually arrested a U.S. Army Special Forces soldier. He's being accused of using classified top-secret information about the capture of Venezuelan President Maduro to place bets on Polymarket. Now here's why this is such a huge deal. This is the very first time the Department of Justice has ever prosecuted a case of insider trading on one of these prediction market platforms. It's setting a massive precedent.
And the numbers here are just mind-blowing. We're talking about a single bet of over $32,000, placed just hours before any of this was public knowledge. The bet was that Maduro would be out of office by the end of January. Well, the operation was a success, and that one bet turned into a profit of over $400,000. Just incredible.
This really brings to mind that old Wall Street saying, when you see one cockroach, you can be pretty sure there are a lot more hiding in the woodwork. And it turns out, this might not be an isolated thing. A very similar case popped up in Israel back in February, also involving a soldier using classified info to bet on Polymarket. It really makes you wonder if this is a much bigger problem than just one person.
All right, let's switch gears and talk about the economy. The big story today, no question, was the reemergence of some serious inflation concerns.
So first, we got the weekly jobless claims numbers. Initial claims came in at 214,000, just a little bit higher than the 210 forecast. Continuing claims were also pretty much right on the money. So all in all, these numbers were basically in line, nothing that was going to shake up the market.
But the real surprise today came from the preliminary PMI data for April. This report showed a pretty significant re-acceleration in the economy. Manufacturing, services, and the composite index all came in hotter than anybody expected, which points to some pretty broad-based economic expansion. But here is the part of that report that really got everyone's attention. It wasn't just about growth. The report literally said that the price data pointed to the most concerning inflation picture in nearly 4 years. And this wasn't just gas prices or something. They specifically noted a widespread increase in prices for both goods and services. That's a huge warning sign that inflation could be heating up again.
Okay, now let's zoom in on some specific stocks. We saw a really fascinating split in the tech sector today that's worth talking about.
Seriously, it was like a tale of two cities for tech. On one hand, you had software stocks just getting absolutely hammered. The sector was down almost 6% after some pretty disappointing earnings. But on the other hand, semiconductors just kept on climbing, extending their winning streak to an unbelievable 17 days. It's a perfect example of a pair trade in action. Traders are selling software and using that money to buy semis.
And speaking of semis, Intel reported their Q1 earnings. And wow, it was a really strong report. A solid beat on every major metric. Adjusted earnings per share hit 29 cents, which was way ahead of what analysts were looking for. Revenue and adjusted gross margin also came in strong.
If we break it down a bit, both the PC and the data center businesses looked really good. The foundry services revenue also looked great on the surface, but it's important to remember that most of that is still just revenue from Intel's own internal divisions buying from itself.
But, and this is a big but, despite those great results, you have to look at the valuation. After the stock popped on the earnings, Intel is now trading at a forward PE ratio of around 80 times.
That is just worlds away from its historical range, which is usually somewhere between 9.5 to 15.5 times earnings. That's a pretty big red flag.
Meanwhile, Intel's main competitor, AMD, also had a great day. And what's so fascinating with AMD is this huge gap between what the company thinks and what Wall Street thinks. If you look at AMD's own long-term guidance for 2028, it implies a price target somewhere between $600 and $800. But Wall Street's consensus? It's way down closer to $400. That is a massive disagreement.
Elsewhere in big tech, we're starting to see some signs of belt tightening. All these companies are spending billions and billions on AI, and that's starting to strain their cash flow. We heard reports that Meta is planning another round of layoffs, about 10% of its workforce. And then there's Microsoft, which is launching a voluntary retirement program for the first time in its 51-year history. It's all about managing costs.
And one last bit of company news for you. Netflix just announced a huge expansion of its stock buyback program. They're adding another $25 billion to it, which brings their total war chest for buybacks to almost $32 billion. That's a move that could boost their earnings per share by an estimated 7 to 8%.
Okay, for our last section, let's pull the lens back and look at the big picture. There are some storm clouds gathering when it comes to systematic capital flows, and it looks like we could be in for some serious headwinds next week.
So, headwind number one is coming from pension funds. The market's been so strong lately that their portfolios are now out of balance. They own too many stocks, so they have to rebalance, which means selling. We're looking at a projected $25 billion of equities selling at the end of the month. For a non-quarter-end rebalancing, that is a record amount of selling pressure.
And if that wasn't enough, here's headwind number 2, and it's just as big. These systematic funds called CTAs, which have been a massive buying force in the market, are basically about to disappear. They bought over $30 billion last week, another $20 billion this week, but next week, their projected buying power completely collapses to almost nothing. A huge pillar of market support is just gone.
So, let's put it all together. Next week, the market is walking into two massive systematic headwinds at the exact same time. You've got record selling coming from pension funds, and a huge source of buying from CTAs is just vanishing into thin air. It really leaves us with one critical question. Who is going to be left to step in and buy to keep this market moving higher?